football formation, asset allocation.
Money mindset. I think that sounds alright.
This is Millennial Money Mindset. If you want the fruits, you need the roots. Thank you so much for joining us. Today, we're talking about football formation, asset allocation, and it's how I created my card game called Football Formation, Asset Allocation. We're going to go through each of the players in turn, explain more about it. So why is it so important? Because it makes investing so simple, and it gives a map to how to get from where you are to where you want to get to, essentially incorporating all the asset classes. So I've built this myself. This is my own theory and my own system that I use for investing. So I was a financial advisor. I used to have £1 million clients come to me and tell them how to invest their money. So I had someone who was investing £15 million of their Bitcoin winnings, and I had to analyze and basically come up with the best portfolio for them. And the best way to explain that to the clients was to use this system that I've created called Football Formation Asset Allocation. And so think of it like investing around a football team. So if you live a good life, you live to 90 years old, like 90 minutes on the pitch. If you score a goal, money goes into your pocket, and if you concede a goal, money goes out of your pocket. And it's basically investing around a system that's right for you. So if you're older, for instance, you could take more of a defensive strategy. If you're younger, you could take a much more attacking a strategy, and you can basically build your portfolio around what's important to you, around your life goals and your aims and aspirations. So yeah, let's get right into it. So essentially, this is the perfect formation, and I've created. So this is called the football formation, and think of it, each player is like an asset class. So the pound coin in your back pocket is an asset that's getting eroded by inflation every day. So the pound coin in your back pocket is losing money if it's not invested. And the house that you sleep in, that is an asset class. So either you're renting and you're paying money to a landlord, or if you own that property, then that will go up in value over historical long-term averages, or you may be renting that out, your room out, and that's money coming into your pocket, and that is an asset. So that's two asset classes. Another one might be businesses. So walk down a high street and there's businesses. Part of those profits when you buy something go to the shareholder, and they get paid in dividends. So this is essentially different asset classes, and each asset class have different strengths and different weaknesses, and they have like personality types depending on the different asset classes essentially have different personality types depending if they're defense, midfield, or attack. So let's go through it. So the first asset class is number one is you're an asset class. So you can go out to work and you get paid an income by a salary or by an hourly wage. So number one is you're an asset class, and you can increase that asset class by your education. So if you go to university, for instance, you might, in years to come, you might get a higher paid salary. If you're a doctor, for instance, and you've gone and trained to be a doctor, then you're going to get a higher salary because you've had that training. Or if you've been an accountant, if you trained to be an accountant, then you're going to get a higher paid wage or salary compared to somebody if you haven't trained perhaps, and you're on maybe like minimum wage and you haven't got kind of those kind of qualifications. So you can do something about that. You can go and train in your part-time. You can go and train and get education and experience to increase your asset. You as an asset can increase how much returns you're going to get. So you can go and understand. If you go and read my book, for instance, you're going to know more about investing, and you as an asset class, you're going to get a better return on your investing. And that's the beauty of being an education. You can increase the amount you get. So the next one up is cash. So cash is another defender. So the pound coin in your back pocket is an asset class, and it has strengths and it has weaknesses. So it has the great strength of cash is it's liquid. You can essentially have that pound coin in your back pocket you go and buy goods and services with that money in your pocket. And essentially the cash is like the puppet master. It essentially without cash, you can't buy other asset classes. You can't buy a house if you don't have cash. You can't buy businesses if you don't have cash. So essentially, cash is super important, and it's part of your defense. So, and it's super important to have, say, an emergency fund. So an emergency fund is, say, if you have any kind of things go wrong, you can essentially going to cover you for any kind of things that go wrong. So going right through it, then you've got, so you can have two ways to make money by investing. Is you can lend money, or you can become an owner. You can buy companies, or you can buy other assets like houses, for instance. You can buy property. So, and these are reflected here. So here is where you're lending money to companies or governments. You're lending money, and here is you're becoming an owner. So that's your defense there. So let's go through this. So bonds. So you want to take off credit cards. You want to take where you're borrowing money. If you're borrowing money, you want to take that player off the pitch, and you want to bring on where you're lending money. So become an owner. You want to become where you're lending money rather than a consumer. So you're lending money and people pay you money, rather than when you borrow, you're paying other people money. And that's a big mind shift change. So then this one is dividends. So where you're becoming an owner and you get paid dividends every year. And this is super important. So people think about shares like the ups and downs of the market. That's only half the story. So the other half of the story is where you own companies and you get paid dividends for the privilege of owning those companies. So if you go and buy a loaf of bread at Tesco's, for instance, or you go buy a burger at McDonald's, or any other company that's on the FTSE 100 or that's listed on the stock exchange, part of those, when you go and buy this product or this good, that will get paid, part of those profits will get paid to the shareholder, and that will get paid back in what they call dividend, and that's essentially you're getting rewarded for taking that risk. So that's that here. So that's your right back. Your left back is where you're lending money, so it's like bonds. Then it's home, so owning your own property. So home is where the heart is. It's the heart of your, essentially it's your midfield, or essentially it's the heart of your defense, or moving into a midfield. So when you buy a property, obviously house prices are crazy expensive at the moment, but you want to have the main part of your property would be a family house, and this will be where you live rather than renting. The idea would be to buy a property, and then essentially you don't pay money to a landlord, you pay money for a mortgage, and then after you pay off that mortgage, you own that property. Obviously house prices are crazy expensive at the moment, but still it's just form part of your portfolio, long-term portfolio. Then moving into your midfield, so these are the wingers. So you've got commodities on the left wing, and commodities is very much driven by supply and demand. So I used to trade gas, and gas is very volatile. It moves up really, really quickly. It's a bit like it moves up and down the pitch really, really quickly. So think of other commodities like oil. So oil was actually came off massively recently because of coronavirus, but it's very volatile. It's very supply and demand driven. Other commodities might be gold. So gold does really well in recessions. So having that in your portfolio can protect you against downside risk. Then also things like wheat as well. So the food you eat is a commodity. So when you go to the shop, you'll buy those things in a basket. They're commodities. So they're driven by supply and demand. So when you go for your weekly shop, you might have realised that prices have gone up recently, and that's inflation. But if you've got commodities in your portfolio, that's protecting you against that price rise. So that's commodities. They rise they go up and down very quickly. Then you've got a tracker. So tracker moves up and down, just tracks the market up and down, similar to a winger that tracks up and down the pitch. And the great thing about these is you don't have to worry about worry about doing analysis of stocks or shares or doing kind of like in-depth kind of research. It just tracks the market up and down. And the beauty of this is this tracker, you don't have to, it frees you from worrying about if you pick the stocks the right time because it just tracks the market up and down, and it's great to have in part of your portfolio just tracking the market up and down because it frees your time up from worrying about the picking the right stocks or are you getting it wrong. But downside, they're a bit boring. You can't go to a party and say I've picked the latest biotech stock or I've picked the latest kind of up and coming business because it's just tracking the market up and down. It's almost like a foolproof strategy. But there are different markets you can track. There's a FTSE 100 which tracks the 100 biggest companies in the UK, but then you can track the world market, or you can track the small companies, or you can track emerging markets, which are smaller companies. So it's not as simple as it first seems. But yeah, these track the market up and down. Then you've got here, so this is what I call knowledge. So knowledge, this is understanding about investing and getting the knowledge that you can think that you know something about the market, something about companies, or something about the market that the rest of the market doesn't fully appreciate. So you can do things like using fundamentals, which is looking at value stocks, looking at the intrinsic value of that company and analysing the price versus the earnings and thinking, is that stock overvalued or is it undervalued, and buying or selling on the back of this. This might be looking at technical analysis, where this is graphs. So you can look at graphs and looking at, is there certain patterns that they're forming? Is there going to be, are there trend lines? Are there highs and lows? And essentially you do this analysis and you think that you have the knowledge or intelligence that you can beat the market. And this is part of your portfolio here. It's doing work, it's looking at trying to pick some winners that's going to do better than the market. This isn't right for everyone. There are other ways to do this, looking at behavioral economics. So looking at we as humans do silly things, like we tend to follow the herd. We get overconfident in the market. We think we're better than we are. Think of driving. Everyone thinks they're a better driver than they really are. There are other things like, we say, loss aversion. So we run away from losses and we feel losses more pain in losses than similar gains. So something like 2.5 times we feel more pain with losses than we do that same gain. And as an investor, you can kind of pick up on these. So look at things like Bitcoin, which, as you can see, is that overvalued? Or looking at the .com boom, for instance, there was big kind of exuberance there, and you can think that you can beat the market. And this is really knowledge. So thinking you can beat the market. Then we come to the strikers. So we've got growing countries and growing companies. So growing countries is like emerging markets. So think of the BRICS, like Brazil, Russia, India, China, South Africa. So 10, 20 years ago, these were very small growing countries. And now there's been a huge growth in these emerging markets. And having these in your portfolio are going to do really well. And these are much more riskier than kind of the more defensive assets. But if you look at but they tend to do much better over long term. So if you look at the frontier markets, maybe this might be the African nations, this might be Cuba, this might be Vietnam. And these are kind of the growing countries. So these are the developing countries. So having these in your portfolio are more risky, but over long term, they're going to give you better rewards. So it's going to be a much more kind of bumpy ride. And that's not right for everyone, but if you're younger, then it's much more beneficial to have these in your portfolio than not having these in your portfolio. Then finally, we've got growing companies. So these are like the FANGs. So think of these FANGs like Facebook, Amazon, Netflix, Google. So 10, 20 years ago, these were very small companies and they've grown massively. So Facebook has had huge growth, and Amazon, look at the growth in Amazon recently, massive growth. So having these in your portfolio are going to grow massively, and it's essentially looking for the next big growth stocks that are going to grow. These are like strikers. So these are much more risky than other more defensive assets. So coming back to Facebook, imagine if you bought MySpace rather than Facebook, then MySpace hasn't grown as much as Facebook because Facebook's kind of dominated. And obviously they're more likely to get you goals, they're more likely to score goals, but then they're also more likely to concede goals. They're more likely to go up, but they're also more likely to go down. And then that's the two strikers, and then it's working out how much is enough. And this is essentially your number. So knowing your number, and your number is how much you need to live on for the rest of your life. And this is having an understanding of how much is enough, and then essentially reaching your number. And this is when you become financially independent and retire early. And this is called FIRE. So just to summarise, this is football formation, asset allocation, and it's having a portfolio of assets that you can build around yourself. So it's about having a defence, a midfield, and attack. So just coming back, so yeah, you've got the different asset classes have different personality types, and each one are going to work for you depending on different part of the economic cycle. And it's building that portfolio around you, essentially to reduce your stress and worry around money. It's getting more money in your pocket. So this is all based on evidence-based research. So there's a number of different Nobel Prize winning economists that I've used to build this model. So it's the modern portfolio theory, which I've used. It's Farmer and French, and they talk about value companies, small companies, and momentum grow much quicker than other types of companies. And Farmer and French won a Nobel Prize for their work. And also Sharpe. So Sharpe won a Nobel Prize by linking risk and reward. And this is basically a great way to understand how risk and reward are related. So my name's Neil Doig. This is a summary of football formation, asset allocation. I've made it into a card game, and it's currently available on my website now and in the shop. So please like, please subscribe, and please tell one person about football formation, asset allocation. This is Millennial Money Mindset. Please like, please subscribe, and hope to see you soon.
Money Mindset. I think that sounds alright.